we're delighted today to be joined by two of my absolutely favorite public market investors. Welcome to Index on Air. And my two industry experts today are Carl Kawaja and Henry Ellenbogen. Carl is the chairman of the Capital Research and Management Community. It's part of the Capital Group, and he's been there for 34 years. Capital Re has $2 trillion under management. So he is extraordinarily generous to take time away from his busy day to spend a minute with us. I know Carl in so many ways, not just as a wise investor, but one thing I'd love to point out is that he's also an incredibly generous philanthropist who has helped the world in many different ways. One of the big ways is the contributions he's made to UCSF, including a COVID test home kit, which I recently tried and was extremely impressed with. So Carl, thank you for joining us today. My other friend is Henry Ellenbogen. Henry is a partner and the chief investment officer at Durable Capital Partners, which is a newly formed investment management firm. Prior to Durable, I got to know Henry when he was the vice president at T. Rowe Price. There, he managed the famous New Horizons Fund since March 2010. And during his tenure there, the New Horizons Fund won the Lipper Fund Award in 2017 for the best small cap growth fund over the last 10 years and over the last 5 years. So a phenomenal track record. He's busy with a new startup. Durable is a startup, even though they manage quite a bit of money already. And so it's really nice of you, Henry, to join us as well. Okay, so I'm going to start off with a question to both of you, kind of a lightweight question to get you warmed up. And I'd love to ask you what you love about your business. Why is it you do what you do? Henry, let me start with you.
You know, I think there's many aspects. You know, I really enjoy meeting entrepreneurs and, you know, understanding, you know, the goals they have. I mean, when you spend time with small companies, you just get to see whether or not companies can really build something sustainable and durable, right? And the great thing about business is it does provide, you know, an absolute scoreboard, right? So unlike so many other, you know, industries where when you know, analyze something and you observe something, it's actually, you know, debatable, you know, what the success is. You know, when you spend time with people and businesses, you can see over time whether they build something that we all know, you know, like, you know, in my early days of spending times with companies like, you know, Netflix and Amazon and, you know, more recently, you know, Workday and Shopify, or whether or not, you know, for some reason it doesn't succeed, you know, and as someone who likes looking at patterns, you know, I particularly like, with the hindsight of time, being able to go back and study essentially, you know, the science behind it. So, you know, it's something we put tremendous effort behind, not only to kind of analyze it today, but go back and really study what made great companies and great people succeed. And then, you know, the second dimension, which is probably a little bit less relevant to the listeners, is the internal joy I get from basically spending time, you know, with my internal team, right? You know, watching people, you know, learn about, you know, business and solving the puzzles and spending time with the people we do, and really, you know, seeing people develop. And, you know, so I really enjoy the mentorship part as well.
Awesome. Carl, you've been doing this for 34 years, so clearly you like it. What do you like about it?
I like a lot about it, Mike. 30 years at Capital, but 34 years, or no, this will be my 30th year at Capital, and I guess 34 or 35 years in total. Well, when I was a kid, I used to love to read books about explorers, like, you know, Captain Cook, Lewis and Clark, Ernest Shackleton, and I feel like in this job you get to be a little bit of an explorer. You know, you don't do quite the acts of extreme heroism and bravery that they did, but you kind of get to see new worlds, and you get to travel the world and learn new things. So for me, it's so exciting. Henry and I have both looked at investing in companies in Brazil in the financial services sector. For me, it's like thrilling to go to Sao Paulo or Rio and visit companies and learn how they're doing things differently. And the range of things that you look at as a public markets investor is so broad. On one day, I'm looking at a company that's kind of treating and in some cases curing a disease like cystic fibrosis. And then, the next day I'm seeing a drone delivery company. And then the next day I'm seeing a traditional TV broadcaster try to reinvent itself to be a streaming company. And so I like the spirit of discovery.
That's awesome. Any particular explorer book that you recommend to the audience today?
Sure. I love Endurance. That's the book about Shackleton's journey. Maybe several people have read it, but it's great. And I've actually read Captain Cook's original diaries, and those are fun too. And in addition to being such an incredible explorer, Captain Cook was also an incredible cartographer. So the maps are really beautiful to look at that he made of the world. And to me, it's so exciting to have seen, some parts of the world that no one had really ever been to before, like the eastern coast of Australia, at least from this part of the world.
That's awesome. I got to get on that book. Good. Well, let's jump into the main courses here. I'm going to start. I wanted to get your views on the macro and the macroeconomic environment. We're in a period where, despite the pandemic, markets are at an all-time high, and that's especially true in the technology business. We do still have a lot of lack of clarity as to the end of the pandemic. We've got something around 7% unemployment, which is historically high. So what is going on in the market, and why are valuations seemingly, at least from a historical perspective, so lofty? Carl, let me kind of cue you up and have you go first on this one.
Okay, sure. And I enjoyed one pleasure of doing this, in addition to seeing you and participating, is hearing what Henry has to say too. So I learn a lot from him. To me, there are two things that really feel important in terms of market valuations right now. I'd say the first one, in my view, the dominant one, is low interest rates. So you and I, Mike, are old enough to have grown up in an era when 0% interest rates were sort of unfathomable, and the idea that you would have negative rates on mortgages in Scandinavia wasn't anything that they taught me in college or business school, and that you'd have negative rates, 10-year rates in Germany, for example. And if the cost of money is zero, then companies that can compound value, especially in the out years, really goes up tremendously. So, if you run a DCF at 10%, 8%, 6%, 4%, 2% interest rates, and you look at two different companies, and company A makes $1 billion a year now, but 10 years from now it goes into decline and gradually goes to zero over the next 20 years. And then company B makes no money for the next 20 years, but then 20 years from now they make $1 billion a year, and then they grow that, call it 15% for 20 years, and then go into perpetuity. Under those various interest rate scenarios, company B goes from being worth less than company to A, being worth less than company to A, to being worth very much more. And so I think we've really sort of seen that to an extreme. And the market that I think is kind of, for me, is a useful guide is Japan, where, starting in the early 1990s, the economic growth slowed there, interest rates fell very dramatically. And, initially the market was terrible there. We did not have that here. But what we have had here is the market paying up a lot for high quality growth companies, or companies that have the prospects of growing a lot in the future. And that's kind of what I see here. And for me, I think Henry maybe was talking about pattern recognition. Like I've tried to apply some pattern recognition based on what I've seen in Japan, and I lived in Japan for capital and work there. And one thing the Japanese market's always done is kind of discount the value of companies with winning products quite quickly. Like they very rapidly present value the fact that company XYZ has a successful solution for, you know, semiconductor manufacturing or a medical device or a better car or something like that. And I feel like we're seeing that at an extreme level here. So if you came to me, Mike, and said, got this great new company in the index portfolio, they make polo shirts for 50 cents and they're even more comfortable and stylish than the one you have on, like, then that's hard to imagine, I know, but I would, present value that very quickly and say, oh, this is going to be a multi-billion-dollar market cap just based on Mike's demand for polo shirts.
There you go. Henry, over to you. Talk about, obviously, some factors here, but also maybe, obviously there's economic cycles. You sort of read in the public that every 9 years, every 8 years, there's a cycle. Doesn't feel like we've really had a cycle, or maybe we've had little ones. Where are we in this cycle? Is this Carl talked about how the interest rates are affecting this. Is this, are you expecting for something to change in the next couple of years, or are we going to be in this environment?
Mike, every time I think about macroeconomics, I just think about the humility, associated with predicting them, right? So, probably a year ago, we would have been talking about COVID had we gotten together, but, most likely 14 months ago, we would have never predicted, the events of 2020, right? Unlikely to talk about, coronavirus. And I think in addition, we could have never imagined, the time frame that happened after that, right? Which, like, if you look at last year, you had a second quarter GDP down 30%. And in the same quarter, you saw the combined same store sales of Home Depot and Lowe's up 30, right? And you actually think about GDP down 30 and home improvement same store sales up 30. If I had said to someone, what's the likelihood of either one of those happening? People would have said, doesn't happen. And if I would have said, what's the probability they both happen in the same quarter? People would have said to me, Martians are going to land from outer space before that happens. Right now, obviously, we can explain what happened because of the extreme, Fed intervention in markets, and then the unlock that basically happened in terms of consumer demand, where you could actually have that happen. So every time I think about predicting cycles, with all that said, I think it is always wise to basically be prepared for a wide range of scenarios, right? Both if you're an investor or you're basically managing companies, right? Because I think that we live in a very volatile world, right? And I think that's the key message I would give people, right? I think there's, 3 levels of volatility when you look at our financial markets. The first one is just the underlying volatility of the socio-political environment we live in, right? The developed world has become very unstable because of underlying, issues in inequality. And our traditional institutions really aren't strong enough to deal with what some people might say is democratization, or some of the unlock that's been driven by, social media platforms, right? In addition, we live in a period of really dramatic, business change, right? The rate that companies are changing is very fast. I mean, we at Durable estimate that more than a third of the S&P 500 companies are under significant business model transition because of what's gone on. What started with TMT has now obviously gone to financial services and healthcare and education. And then the last thing is just really market structure, right? The number of passives in the market, quants, and then recently the size of retail investor has meant very few investors really do deep fundamental analysis and have a long-term holding period, right? And so when you add up all 3, I think you end up with very volatile markets. And the proof point of that obviously was last year, right? The Q2 was technically a bear market, and it was actually the shortest bear market, in the modern era. Even though I would argue the flash crash, of '87, by definition, you would think flash crash versus what happened with our pandemic and a true recession should have been faster, but actually one lasted for 1 month and the other one lasted for 3. And if you look, within markets, the market I spent a lot of time on, which makes up, the vast majority of companies, albeit small companies, Russell 2000, it had its best quarter in history in Q4, following the worst quarter in its history in Q1. And so that, I think, just speaks to the volatility. And so I think if you think about public markets, you think about financing your company, you think about preparing your employees, you just need to accept that we kind of live in volatile times.
Now, both of you are standout investors because you don't just do the math, but you also talk to the CEOs and you become, in many cases, their advisors. So faced with this kind of a market dynamic with the interest rates and volatility that you talked about, what advice are you giving your CEOs about how they should think about their business? And this is particularly, obviously, people are listening to us today because they're mostly in the startup universe. So they're early, they're doing venture stuff. So they're raising money. And, faced with this kind of a climate, should they be raising as much money as they can? Or do they feel like, look, don't worry about it, this is going to be like this for a little while? And the other question is, of course, deployment of that cash. Should they be aggressively investing in the expansion of their business, or should they be a little bit cautious because, who knows what's going to happen in 3 months or 6 months? Carl, let me start you on that.
Okay, but I feel like Henry's a real expert here, so I'm going to defer to his advice. One thing I would say, though, is it seems pretty easy to raise money right now. But if I were a founder or CEO, entrepreneur with a company, I think I'd be a little careful about how much money I raise. I think it's tempting to say, gosh, it's easy to raise money right now. Let me raise a lot of it, save it for a rainy day. But sometimes I think you can kind of drown in too much money and you get a little soft if you raise too much money and you start doing things in a sloppy way. And I think sometimes there's some element of hunger and feeling like you need to economize that. And I think it's really easy in this environment to lose that discipline. So I guess that's one piece of advice I would have for some of the companies. I guess another piece of advice I would have for them, it's something that I feel like I've seen Shopify and Amazon do particularly notably, is kind of rely on yourself and build as much for yourself as you possibly can. It's kind of easy sometimes to put together a company by relying on other people, and kind of you end up, I think, running the risk of outsourcing something that's a core competency because there's something that's kind of easily available out there and you don't want to take the time to build it yourself. And I think you had sent us Index, Mike, you guys had sent us a list of kind of things to say, what kind of companies you're interested in investing in. I think your questions were great markets, great founders, disruptive technologies, best of breed metrics. Yeah, of course, all of those. But another thing I would add to that is I'm interested in companies that do things that are hard to replicate. Like some companies do really cool things. There's a giant TAM and the founder's a great guy and it is a disruptive technology. But over the broad swath of time, it's not going to be that hard to do. Other people will come and copy it. And I think everything you can do to sort of ensure that what you do is very hard to replicate is kind of a fundamental source of value. And the more you can invest in your moat that way, I think the better it is. Henry, I'd love to hear your view on this one.
Yeah, I agree on a lot of what Carl said. So, in many ways, it may be among the best times to raise capital. And we may look back with hindsight and realize it was among the hardest time to build a company. right? And so, everyone on this call remembers well, the TMT cycle, right? And if you look at it, some great companies really did come out of all that capital, right? I think about Amazon, that had come out of that, and actually Priceline, although had to be reborn under Jeff Boyd and Bob Mylott, came out of that. And then if people remember, actually Google and PayPal actually came out of the aftermath of it, right? When capital became scarce, and those two companies actually were really focused on fundamentals, and then attracted a lot of human capital in a time when actually there was kind of a mourning after the parties of the TMT bubble, in Silicon Valley. And I think that's, pretty instructive to think about. So if, what I would think about, and what I tell founders if, you're raising capital is, the goal is not to raise capital. The goal is to build something, sustainable and durable. And I think in order to do that, the formulas are really the same, right? You got to basically solve a customer's need, drive product market fit, have an initial management team that can scale, and have solid unit economics so you can basically support your own growth. And then you basically have to use that while you basically drive market share, and then invest in your, second act, not only in terms of business, but also in terms of the people, process, systems that can scale the business. And I think that, when you have times like this, it's very easy to basically, skip steps, or basically, to Carl's point, not use the discipline that, capital markets at times or historically have provided. And I spent a lot of time, talking to people about the true lesson of Amazon, right? Which, Carl knows, Jeff Bezos, very well. As an early investor, it was one of my investments. When I worked at T. Rowe, we were, their largest outside shareholder for many years, after the TMT bubble. And many people like to think that the story of Amazon is really, aggressively spending and not driving profits. And actually, the true story is, after the TMT bubble, the company became very focused on getting the retail business to, solid profitability, bringing in a team of people who were excellent operators, having incredible rigor in the operations of the company, monitoring them with an incredible focus on KPIs and discipline, and then using that self-generated cash flow to drive new initiatives. Some of them extended and expanded the retail moat, and other were more adjacent, like AWS. And then among those, also held those accountable to different metrics. And I think that mental model is really a good one, right? Because, here you have a company that basically did survive, a period of, speculation, and then really, focused on driving fundamentals, and obviously has built, a very, valuable business. And then, the other thing that I think about with these markets, just to kind of touch on quickly, is I do think there is a lot of noise around the transition from being private to being public, right? The traditional process among, traditional IPO process, which, I'm far junior to Carl. I've only been in this business for, 20 years, but, the IPO process that, I got so used to, for 20 years is obviously going through, rapid change, right? And I have my own view as to what might happen in a couple of years, but I think the thing that I tell people when they call me up and say, Henry, should I do a traditional IPO, or should I do a direct listing, or what do you think about a SPAC? I always say, at the end of the day, there may be multiple avenues, but the goal of an IPO, I don't think has changed, right? And if you oversimplify it, the goal is to get the company public, find a handful of long-term shareholders that will both hold the company accountable and be willing to stand by it in tough times, so that the company can basically build a durable and sustainable business, and basically, provide capital to it, assuming it kind of stays on track if it needs it, as well as transition in an efficient and fair way from private to public, the people who basically need to exit, and basically the employees who want to exit, as long as basically re-incentivize the new employees who are signed up for the next journey of the company. And I think if you look at the goal as that, as opposed to all the gamesmanship in between, it really makes it much easier to kind of navigate the choices people have there as well.
Yeah. I want to stay on this subject for a second, Carl. I'd love to get your views. Henry's brought up the subject of going public. So two things, Carl, that'd be great to kind of hear your views on. With a ebullient market and multiple pathways to go public, more companies right now are considering life as a publicly traded entity. I guess the first question is, is the bar lower now? Should companies more readily go public because they can? And the second question is, there's the traditional IPO direct listing conversation, which has been around for a while, but the SPAC theme is definitely somewhat unusual. And I'd love to just get you to broadly talk about these SPACs and how you feel about them.
Okay, sure. I mean, in terms of going public, I think in some cases people kind of underestimate the kind of time commitment and distraction that being a public company represents. I mean, it's in my incentive, it's in my interest to have all companies be public because I want to increase my opportunity set as primarily a public markets investor. But I think if you are in a good situation in terms of your balance sheet, and you feel like you're not ready to go public, I would not rush it right now just to sort of take advantage of this window. I don't think it's going to disappear forever or anything like that, even though it is particularly good right now. On SPACs, like everyone else, we're seeing more and more of them. SPACs are complicated, and we sometimes find them a little hard to wrap our arms around. I think some people are kind of rushing SPACs, and particularly if you're kind of towards the end of a 2-year window of the SPAC, then those are deals that I'd be more cautious about. And one thing that we sort of scrutinize with the SPACs is, what is the kind of underlying dilution that you're going to run into because of the warrants? I sometimes feel like there hasn't been enough disclosure around that. So as a public markets investor myself, I guess if I were to choose whether I'd rather invest in some promising company that you guys have at Index Ventures in the form of a SPAC or an IPO, I'd be more interested in an IPO. I understand why a SPAC might work for a company, but all else being equal, I'd prefer the IPO route as an investor. And you have to be convinced that the folks that you're getting kind of in business with in the SPAC are reputable, trustworthy, credible, and aren't taking too much of the gains for themselves. Because in a way, the SPAC, whoever set up the SPAC in the first place, has tremendous kind of economic incentive that isn't always 100% aligned, I think, with the interests of the investors or the entrepreneurs who go public via the SPAC route. So I'd be careful about them. What do you think, Henry, about SPACs?
I believe that, we're going to learn a lot about SPACs kind of once we see the other end of this cycle, right? I think, intuition would tell you that when there's incentive to basically go find companies, right? So you look at the simple incentives of a SPAC sponsor, right? Where if something doesn't get done, they lose money. And if something gets done and everyone else breaks even, they still make money. That's not good incentives, right? And we know that the bankers basically make multiples more, through a SPAC than they do through a traditional IPO. And then, I think the incentives of companies themselves are I would say, can be obscured, right? Where on one hand, I would think the incentives of companies going public is really to basically properly set up its shareholder base and basically have a fair transfer of value and focus on compounding. But, there are people around companies that are much more focused on, a first day price or basically some type of, certainty, right? And I'll just say, deeply practically, when you look at the quantity of SPACs that are in the market relative to the long-term shareholders to consume them, it's hard to imagine how, there's not a cycle that has to get kind of flushed out. The other thing I think about when I think about what's going on here is the risk to the SPAC CEO and the employees when it's not a question of if there's a market downturn, and investors who short stocks, which obviously neither durable nor capital does, are likely to basically really focus on SPACs because they basically skip the step to going public. And, for the most part, the category of those companies are viewed as lower quality. And I think they'll basically attract tremendous stress from, a weak public market. And so, if there's a market where certain companies go down 20 or 25%, you could see the category of SPACs going down 35 to 50. And that just puts tremendous stress on companies, not only employee bases, but partners, and especially if a company is really doesn't have hasn't built core business model at that point in time. So I think that we'll see the result of this cycle with the fullness of time, but I think that the risk to companies is relatively high who go through this route.
Yeah. Thank you. Let me switch subjects for a second. There's been, especially in the last few weeks, there's been a lot of talk about retail investors, democratized access to the financial markets, Robinhood, which is one of our favorite portfolio companies at Index, GameStop, etc. As you look at this scenario unfold, Henry, maybe I'll start with you on this one. Does retail really affect the way stocks have and will behave in the future, more so now than in the past? Or there's just a little blip that Reddit readers constructed for us? Like, what's going on with this retail thing?
Well, I think part of it is not only retail, it's just overall market structure, right? So I think before retail really picked up, which was, call it, 2 years ago or so, Mike, I know with your involvement in Robinhood, you probably have, more precise data than I have. Market, over 80 to 90% of trading was basically being done by quants, right? And so as we know with market structure, you have a huge percentage of owners who are index funds who basically hold. They don't basically trade. And then you have, a big group of quants, which are basically powered by machine learning that basically, aggressively trade, right? And then you really have, call it 15, 20%, let's say 2 years ago, that was really investors who basically evaluated companies on fundamentals. Now, over time, that assets get priced and the markets sort themselves out, right? And so now, obviously, you have a significant percentage of volume. I think, over recent periods, it's been more like 20%, being driven by the Robinhood phenomena, right? And so you did this against a market structure that was inherently volatile, right? Because one of the factors of quants is momentum, and these signals from alternative data sets and price momentum, which is one of the reasons Citadel buys Robinhood's trades to basically get that into their quant models so they can make decisions based on it. So it's a long way away of saying that the market itself, is set up for, short-term volatility by this factor. And I think we saw it. I talked about how volatile Q1 was and how volatile on the other side Q4 was in an environment that I don't think, should have made the Russell, the best and worst quarter, recent, in history. And so I think you're seeing that phenomena. My personal view is over time, assets in markets tend to get properly valued, right? The old adage that the market's, basically a sentiment driven by sentiment in the short time and a weighing machine over time. And, the other thing is when you have bear markets and basically, speculation goes away, then you usually see assets end up in their rightful hands, right? You've seen this, through the course of market history. So it will basically get washed out over time, but certainly over short periods of time, market trading really does drive asset prices. And I think we saw that, in January.
Carl, we're going to run short on time, so I'm going to give you 1 minute for this one, and then I want to ask you guys one more question. What do you think of the retail impact on your business right now?
I think it sort of has a pretty tangential impact on the institutional investor right now, I would say. GameStop was fascinating and interesting to read about, but not that big a deal yet. And, for our firm, we have over 35 million individual shareholder accounts and, 55 million plus total accounts. Like I would say we do represent the small retail investor, but just as an aggregated entity. So.
Great. Listen, I want to close out with one question for you guys, which is prediction time. Tell me what you think the market will look like at the end of 2021. We won't hold you to it, I don't think, but prediction time is prediction time. So, Carl, starting with you.
Well, your question said trends we should keep an eye on. That was a prediction one that I had prepared for.
Go for the trends. It's good. Go for the trends.
Where will the market end from here? I have zero idea. And if I did, I'd take advantage of it, and it'd be super easy. One thing that I'm watching, and maybe I'm sensitized to it, Mike, and but I know it's an index ventures area of focus as well, as autonomous vehicles. I feel like we're getting kind of closer and closer to it, and more so than people realize. Like I really think the capability of AVs has improved tremendously, and I think there are a lot of skeptics who think it's never gonna come and it's never gonna arrive. Of course, Waymo has it, to some extent in Chandler right now, but I think we're gonna wake up one day, and I think that day gets a lot closer at the end of this year, where AV seems like a real phenomenon. And I also know, Mike, that you personally are a little bit of a Bitcoin believer, and the move in Bitcoin has been kind of startling this year. But another thing that I would be watching is central bank digital currencies. The Chinese government's looking very seriously at it, and I think we're not that far away from a future where all of our financial transactions, other than kind of in a distributed platform like Bitcoin, are traced by the central bank. And so when you get paid, your taxes get deducted automatically, and you don't send the government a check at the end of the year. I think that'll seem antiquated to us, and that might drive demand for Bitcoin, because people will want to have transactions that aren't necessarily overseen by the government.
Yeah. And Henry, same question to you then. Trends for 2021 that you're paying attention to, and if you have a prediction, you don't have to give one. If you have a prediction, we'll take it.
I'll defer to Carl. He's better at predicting markets, short cycle than I am.
No, I'm gonna write down your prediction if you have one. I have my pen out. I'm ready.
So I'll give you a trend that we're watching, Carl and Mike. And I think one of the things that we have talked a lot about, internally is the way we work, live, and we're focused on where we live is just fundamentally changed because of COVID. So one of the things that may interest people is if you go back and you study American history, we started to suburbanize or spread out in 1810, with the ferry boats, right? And if you study American history, we're, what I would argue, just entering the fifth wave of suburbanization. And generally it's been driven by technology, but sparked by a war or a significant event like COVID, right? And these cycles tend to be long cycles, and they're very important for a couple of reasons. First of all, in this cycle, I think you have two going on at the same time. You have knowledge workers and asset owners believing that opportunity and geography are spread out, right? So people are going to the Sun Belt as well as, previously more resort or, what were viewed as secondary cities. And then the second thing is, as companies make statements about long-term, couple of days a week, work from home, people go to suburbs. And then the services that surround these employees basically also spread out. And this is important because it basically unlocks productivity in America, right? As we monetize the richness of the American continent, which is very unique, right? Most other developed markets, as we know, or countries are countries, we're a continent. And many of the other big ones really don't have great, rich land. That allows people to go to lower cost locations, and basically that's a productivity loop. The other thing is the innovation to basically provide things like financial services, healthcare, even mundane things like accounting. We're investors in Intuit. As an example of this, all of a sudden can be done more remotely. And this kind of taps into another strength of America, right, which is our entrepreneurial nature. And I think the combination of the two, combined with these ends up being long cycles, has an ability to be really powerful for this country, right? As we know, ultimately GDP growth is a function of population and productivity. And I think that, if we get a couple of things right, from a societal standpoint, a political standpoint, we could be entering, a significant positive period of productivity in America. And so I think as investors, we would all benefit from that. But if you can really get on the front end of that, these tend to be long cycles.
Well, guys, we're unfortunately out of time. It's always such a pleasure to talk to you because I really do walk away with fascinating insights. I'll take the liberty of just doing a quick summary of 6 takeaways that I had from this. First, that low interest rates are here to stay, and they're going to drive valuations, and they will drive businesses that trend towards growth effectively. 2 is volatility for a variety of reasons is likely to continue. Shorter mini cycles, ups and downs and swings, which will become a fact of life. 3 for Spax, caveat emptor. 4, hard to predict where we are in the cycle, but a general sentiment towards optimism. 5 is focus on building great businesses over the long period, not on valuations over the short term. And then in terms of trends, I think both of you essentially talked about the movement of people. Carl, you talked about AV, which is the movement of people in the near proximity. Henry, you talked about movement of people, but both of those fundamentally unlocking some very, very interesting productivity trends, which should be pretty optimistic for our economy overall. So with that summary, I just want to thank you both. Please come back again. We'll try to do another one of these sometime, and best of luck to you.
Thanks, Mike. Thanks, Henry. Good seeing you.
Thank you, Mike. Thank you, Carl. Bye.